I just love this idea for the AI bubble pop, because I don't know if you've noticed, Peter, ever since the .com, well, ever since the global financial crisis. So the global financial crisis was the second crisis for the millennial cohort, right? We heard about the .com crisis like from our parents. Maybe we had to suffer through that a little bit. If you had parents who were heavily invested in the markets, whatever. But you heard about it constantly. .com. It was 10 years of the market being down and then going back up. Then the global financial crisis hits, and that's where we were like, hey, what's going on? Like, we were promised a type of life. Our parents beforehand, their grandparents and all that, they were able to invest in the markets, and turns out we're losing it all, and houses are gone. It was a whole thing. And so it's been basically PTSD for the millennials since then. Just when we were getting out, right? So it was 10 years since the .com crisis, boom, another crisis. 10 years from the global financial crisis, boom, COVID hits. Market goes down, and we all think markets are going to go down for another 10 years, just like it did last time, the time before that. No, not only is it not going to go down for the next 10 years, it's going to go down for about 2.5 months and then skyrocket. And just when you think it can't go any higher, it'll go 300% from there. Let's keep going. So I don't know if you've seen, if you ever look at a chart, like, let me just pull one up just for the sake of so to talking about it, because it's just bananas. You take a look at what the Nasdaq has been doing, and it's just been insane. So 1 second here. Yeah, so you take a look at the Qs.
And the Qs, as everyone knows, are
the Nasdaq, the ETF for the Nasdaq.
Right. Correct.
All right. So this is what you're seeing over here is a .com, right? .com bubble. It went down. So 2000 to 2003, low. And then it crawled up from 2003 all the way to 2008, right? Actually, we're on the logarithmic chart. Run the regular one. To 2008. Then it crashes again. And then it crashes, and then it goes up. It comes back up to where it was before, around 2011, 2012. But it's been choppy. We were worried about it, so a lot of people didn't get in. Right? We had all these dips and dips and dips and dips that people were worried about it, and then it just took off. It just took off after that. This is Donald Trump and Brexit. Then you head up to another run up. So a lot of people here were like, they thought bad times are coming. Like, we had the .com, we had the GFC, it'll crash again. It didn't crash again. They missed it. But then they finally get in. They finally get in over here, and this is the COVID crash. Then they're like, okay, I knew it. I knew all this. The Peter Schiffs of the world were right. We're going to crash. It's going to come all the way down to over here. I mean, I thought it was. It would come all the way down. It's going to be down 50% or more. It'll take another 10 years for it to go back up. No, immediately it recovers. So this COVID crash is a 23% drop. That within 2 months or 3 months is back up to where it was before. Sorry, that was the COVID crash. What are we talking about? COVID crash is over here. This is the drop here. From here to here is 30%. So here we had Volmageddon. So just I think a year before, we had the beginnings of the market crash. Volmageddon happens, and then just that recovered, and then immediately another crash. That happens over here, and then it just goes up, right? So from the lows over here to the top, it goes up 151%. It goes up 151%, and people are like, "Oh my God, this is unbelievable!" Fortunes were lost and made here, buddy. Lost. In here is GameStop. Here's AMC. In there is NFTs and meme coins. In there is what was that big one that happened? Bitcoin. All-time highs, just launching. Then they get back in, and it rolls over again in 2022. Inflation, the worst inflation the world has seen since the 60s, and it just eats all the middle class and poor people all their lunches, while the rich get richer, right? Because the inflation goes up, but
assets.
yeah, the inflation goes up, but the actually, let me just go back to that. But the bonds that were at 0% before now are at 5%.
Mm.
So people are like, hey, why am I risking stock picking? Let me just put money in the bonds and I'll get 5%. Plus, then I could do some other things in the markets. Well, if you don't have $100,000 minimum, who cares? You're not getting any of that. And if you're retired and you have enough money, all you really need is 4% off your money. So we had this drawdown, and then people are like, okay, it's not worth it to get into markets. We had a drawdown of 34%, so bigger than the COVID drop, right? While they're screaming no recession, everything's fine, inflation is transitory. Eggs here are 16 billion times what they were before. And then the market goes up again, another 100%.
Is that because of AI? Is NVIDIA dragging that up?
Well, you had this perverse effect where you had this weird effect where.
By the way, this hand gesture is for people who think they're better than other people.
Yeah. I'm sorry, that's who I was emulating. You have $4 million to $50 million. You're putting that money, you're getting 5% guaranteed. So now you're making more money, right? You're not risking the things like you were in the stock market. You still have some exposure to stocks, so those are going up. But for the stocks, especially since so many stocks don't offer any dividend, the only way those people were able to monetize that is that they have to sell their stocks, right? They have to sell their stocks in order to actually consume.
So why is it going up if people are selling their stocks?
When they moved it into bonds, they don't have to sell their bonds. Their bonds they can hold for the whole maturity, 2, 5, 10 years, and get paid interest every 3 months, 6 months, 1 year, right? So now they're getting money that's like, this is free money. This is not like, oh, I have to wait for Apple to buy back its stock, or I have to pick some pharmaceutical go up. I have to invest in Lockheed Martin and whatever. I don't do any of that. I just have to hold these government bonds, which I can sell at any point and claim interest on it. And it just keeps going up. You just buy more bonds. So then they had money to spend. They had more money to reinvest into the market.
And that's what caused the upswing?
Rise up. Well, this is what I really want to come on today, because what I want to talk about DeepSeek is that there's these structural forces behind the market. That there are these buyers and sellers. So there are voluntary buyers and sellers, and then there are forced buyers and sellers, right? You and I are voluntary. Our income is not dependent on the stock market, whatever. We just invest inside of it if we want to, and we sell it anytime that we want. A pension fund that has to return 4 to 7% to their pensioners every year has no choice. They have to sell a certain amount of stock at the end of every year, and they have to invest the money. If it's a hedge fund, if it's a family endowment, if it's a government entity, some sovereign entity, whatever it is, if their mandate is we have to have, a 60-40 portfolio, we need to have 60% stocks, 40% bonds, they don't have any choice. They have to buy the stocks and bonds or sell the stocks and bonds under certain circumstances.
And that's predictable.
Exactly. It's very predictable that they have to do these things. Predictable in the sense that it will occur. There are things in then that come into play, like COVID, like the crashes that we saw, that can then like shake things up. Maybe changes the rules. Maybe changes, once something gets big enough, maybe they go, well, maybe we shouldn't do it this way. Now let's do it a different way. Now let's go from 60-40, where it's 60-40 stocks and bonds. Let's do 50% stocks, 10% Bitcoin, and 40% bonds. Well, now Bitcoin's going to go up because 10% is buying it. 10% money is flowing into it, as an example. And so the rules can change, but what doesn't change is that the forced buyers and sellers and the large players are what move markets.
And where does M2 fall into this?
Well, you don't even have to worry so much about the empty money supply, because that's not even
blasphemy.
Well, the empty money supply is not even like the big canary in the coal mine. If the stock market, Kim Carson talks a lot about this, is where I learned a lot of this from him. If the stock market goes up 20% in the year, that means the stock market, if it goes from $100 trillion of value, at the end of the year it goes to 20%. Now it's at $120 trillion of value. Well, that $20 trillion extra is value that's there for everybody, that for the people who own the assets. So now at the end of the year, they have, in aggregate, the market has $20 trillion more that can be spent, that can be invested, because they could always borrow against it or sell,
Right.
but they could borrow against it. It could be used as collateral to then buy more things. So you can buy stock, not with the stock. You can buy stock by, in a sense, leveraging the stock that you have to get a loan to then buy more stock, which makes the stock go up. And then
This sounds an awful lot like Michael Saylor's gambit that you
this is a
say
Ponzi scheme.
is a Ponzi
This is a
scheme.
Ponzi scheme. This is more of a scheme. I'm not sure what kind of adjective you put in front of it, but it's a scheme.
Is it maybe like a diamond? Like a maybe
It's like an inverse pyramid if gravity was this way. A reverse pyramid. So you get these flows. So us as retail fishermen, we have to pay attention to these in order to see what's going on.